Right after Donald Trump won the 2024 presidential election, fresh data from December showed something interesting. Many countries started pulling back on how much US government debt they held. Out of 20 major economies that usually invest in US Treasury bonds, 16 decided to cut back. Some of the biggest drops came from the United Kingdom, which reduced its holdings by $44.1 billion, Japan by $27.3 billion, and Saudi Arabia by $15.1 billion. Other countries trimmed their investments too, though by smaller amounts. China by $9.6 billion, Switzerland by $9.7 billion, and India by $14.9 billion. So why the sudden pullback? It seems many global investors and central banks were feeling cautious. They were concerned about what Trump's policies might mean for the economy and didn't want to get caught off guard by any surprises. This isn't a new strategy. Countries that invest heavily in US debt keep a close eye on things like trade policies, diplomatic moves. If they sense anything unpredictable or risky, they often scale back to avoid potential losses. One big concern is how much money the US government plans to borrow. If investors think upcoming policies might weaken the dollar or balloon the national debt, they might see US Treasuries as less appealing. When lots of foreign investors sell off these bonds, it can push up interest rates, making it more expensive for the US government to borrow money. This doesn't just hit Washington. It can also mean higher costs for American families and businesses, like pricier mortgage rates or more expensive business loans. And here's the bigger picture. If this trend of selling off US debt continues, it might make people question the strength of the US dollar as the go-to currency for global trade and savings. For decades, the US dollar has been the king of global finance, but when foreign countries start pulling back from US government debt, it raises eyebrows. If this keeps happening, it could signal a slow shift toward other safe haven assets like euro-backed bonds, different major currencies, or even old school gold. But this isn't just about numbers on a spreadsheet. The sell-off following Trump's 2024 election win might reflect deeper tensions bubbling under the surface. When trade disagreements flare up or diplomatic ties get strained, big investors from other countries often start moving their money elsewhere, even if they don't make a big fuss about it. The thing is, these changes can happen quietly. A country doesn't need to make a public announcement to make an impact. Slowly but surely, as they cut back on US debt, it can chip away at the dollar's global dominance. And if future policies stir up more uncertainty or spark fresh conflicts, what started as a post-election shunts far and wide away from US markets. Central banks usually stock up on US Treasuries because they're considered super safe, kind of like a financial safety net. But lately, many countries are rethinking that strategy. They're looking to balance their reserves with other currencies or assets, especially gold, to avoid putting all their eggs in one basket. This movement, often called dollarization, is about reducing reliance on the US dollar. China, for example, has been quietly trimming its stash of US Treasuries, which dropped to $76.1 billion in October 2024, the lowest it's been since 2009. It's all part of China's bigger plan to diversify and reduce its exposure to the US financial system. One major reason countries want less dependence on the dollar is because of the power it gives the US in global finance. The US can use its influence to impose sanctions, which has made some nations rethink their heavy reliance on dollar-backed assets. This shift isn't just tall. The Unhedged podcast recently highlighted how central banks and sovereign wealth funds are scooping up gold as a shield against potential sanctions. Countries like Poland, Turkey, India, Iran, and China have been leading the charge in this gold buying spree. There's also a more tactical reason for some of these sell-offs. Currency control nations sometimes sell off US Treasuries to strengthen their own currencies. Japan, for example, reduced its holdings from $1.087 trillion in November 2024 to $1.06 trillion in December, likely as part of efforts to stabilize its currency. Japan's recent move to trim its stash of US dollar assets wasn't random. It was part of a bigger plan to boost its own currency, the yen, by selling off US Treasuries and buying more yen. Japan aimed to strengthen its currency and stabilize its economy. But there's a trade-off. When countries do this, it often means they end up holding fewer US bonds in their reserves. Meanwhile, back in the US, Treasury yields have been climbing. Why? A mix of policy changes, like tariffs and shifts in immigration rules under Trump's administration, has stirred up expectations of stronger economic growth and possibly rising inflation. When inflation goes up, interest rates tend to follow, pushing up the yields on government bonds. But here's the catch. When yields rise, the value of older bonds, those issued at lower rates, drops. This forces investors to rethink their strategies. Adding to the pressure, the Federal Reserve signaled that it might slow down on cutting interest rates in 2025 because of inflation concerns, which only reinforce the upward trend in yields. Zooming out, there's been a bigger, more strategic shift unfolding over the past couple of decades. Since the 9/11 attacks, the US has used its financial system as a tool of influence, leveraging the dollar's global dominance by controlling access to its banking system and imposing sanctions. The US has been able to apply economic pressure on countries like Iran, North Korea, and Russia. But this power play hasn't gone unnoticed. Countries on the receiving end of these sanctions, and even some allies, have started asking, are we too dependent on the US dollar? This question has fueled the global push toward what's known as dollarization, reducing reliance on the greenback. One of the main ways countries are doing this is by trading directly in their local currencies. China and Russia, for example, have been ramping up trade deals using renminbi and rubles instead of dollars. India and Iran have also explored similar setups, making it easier to bypass US-controlled financial channels. Another big move has been building alternative banking systems to get around SWIFT, the global messaging network that most banks use, but one that's heavily influenced by Western powers. In response, Russia developed its own system, SPFS, and China rolled out SIPs for cross-border transactions. These systems give countries more control over their international payments and help them dodge potential US sanctions. On top of that, global alliances have been joining the push. The BRICS group, Brazil, Russia, India, China, and South Africa, has been actively discussing creating a new reserve currency that could rival the dollar. Russia, in particular, has been urging its trade partners to switch to alternative currencies, especially after facing waves of Western sanctions. Even the oil market, long dominated by dollar-based deals, is seeing cracks. Countries in the Gulf Cooperation Council, GCC, have started considering accepting payments in other currencies, like the Japanese yen, hinting at big changes in global trade habits. Central banks aren't sitting still either. Many are shaking up their foreign exchange reserves, pulling back from US treasuries, and stocking up on gold, a classic safety net in uncertain times. China, Japan, and India have all been quietly shifting their portfolios, cutting their US bond holdings while boosting investments in other assets. Countries around the world have been making quiet but deliberate moves to shield their economies from the ripple effects of US monetary policies and potential economic pressure. This shift isn't about ditching the dollar overnight, it's about creating more options and reducing over-reliance on a single currency that holds immense global power. The idea of the US dollar losing its top spot as the world's go-to currency might seem far-fetched, at least for now. Global politics, the strength of new financial systems, and how well countries can work together to sidestep dollar dominance. While the dollar still reigns supreme, cracks are starting to show in the foundation. But this isn't the first time the world has seen a major currency shift. Before the US dollar took the throne, it was the British pound sterling that ruled global finance. The pound's power was closely tied to the British Empire's vast network of colonies and trade routes, making it the top choice for international commerce during the late 19th and early 20th centuries. Thanks for watching.